Hi, and welcome to Risk and Robots, where we navigate the future of risk. I'm Max Eber, co-founder and CPTO of Taktile. Today, I talked to Monzo's Peter Liu. After running product at Canada's leading challenger bank Coho, Peter is now heading up product for Monzo in the US. So there's a ton of insight into what it takes to replicate a winning model across geographies. We talked about why risk and product cannot be separated in financial services, how to mitigate credit risk with UX, and why sometimes you need to take on more risk to find product market fit. Let's get into it. At Tactile, we think a lot about the fact that you can't really separate your decision strategies for how you decide to treat your customers from the product strategy. In onboarding, your fraud strategy will determine how UX looks like for the actual sign up. And the same goes for credit. So I'm curious, as a product leader, how do you think about the connection between product design, but also decision design, decision strategy?
Yeah, like I'm a big believer in like all things put together. Like one of the things that I really, really like think is really important for everyone in an organization to internalize is that like risk, product, and all these like other cross-functional teams is everyone's responsibility, and it's everyone's impetus. They have their own impetus to like really understand how everything works. So going back to your question, like I think of it as all the same in order to actually like deliver a cohesive experience that you want to serve to your customers. The PMs really, really need to understand um, how decisioning is made, and vice versa. The risk team needs to really understand how uh, the design of the product is and like the intention of the product strategy. And I think it all comes even like from the top in terms of like what the cohesive product strategy is and even what the ICP is. So like I'll give you a good example of this, which is like let's say if Monzo is going after the expat market in the US. In order to do that, we need to better understand like, okay, like in this the market that we're like trying to target, they have unique traits of their data sources because they're newcomers. They may or may not have credit scores. They may or may not have a digital footprint in America, and so on and so forth. So as a result of that, the way we design the product, the way we underwrite the risk of these people who we onboard is completely different. So like to take a step back, the point I'm trying to say is like everything is all the same, and it all has to be cohesive, and it needs to be from the top around what is the ICP and what is our product strategy and how are we trying to go after that market.
Yeah, I love that. And do you have an example from your career where this worked really well in a product you've built historically?
Yeah, let me just think through this a bit. Yeah, actually, a really good one here is during my time at Coho, one of the things that, like, the initial product we had was this no fee debit card product for Canada. And one of the things that we knew was a lot of the people that we were serving were, call it subprime slash near prime. Okay. And the decision that we were trying to like wrangle with is like, okay, like we believe there's an unmet need around credit, and we want to be able to provide credit for these users. However, like the thing that made the first iteration of the product kind of hard to like wrap our heads around is like, how do we underwrite to people who may or may not have good credit scores? How do we underwrite people who are in like credit recovery, even though they have unmet needs around credit? So as a result of that, we really needed to take a step back from like the lens of like Peter, the product guy, or X person, the risk person, and be like, okay, like what is the amount of risk we're willing to take to try this out? And this is a form of like capital, capital we're willing to shell out, time that we're willing to shell out, and really like log hands and be like, okay, like maybe we do need to go down in terms of like the risk deciles we're willing to underwrite to actually just see how this works, because it is inherent in our strategy that like all these people we're trying to underwrite to are subprime, and there's not much we can do about it in the short term unless we really like just go up market, which is like a whole different strategy in a nutshell. So like we're able to effectively build out the right lending products and the right like underwriting strategies by really like understanding who our ICP is and understanding the limiting factors of it, and just lock hands to agree on an appropriate amount of risk for these people.
Cool. I love it. I mean, And I think one thing that's also very common in product management nowadays is people look at metrics, right? Everybody's very metrics driven. You steer with metrics, etc. But the product metrics and the risk metrics, they're not really the same. And product metrics are maybe NPS scores or active users or things like this. And then risk looks at approval rates or default rates or chargeback rates, etc. So do you think there's an opportunity here for these also to converge? So product folks, they use the risk metrics and vice versa.
Yeah, it's actually interesting you say that because one of the things I've like thought more about as I like started like as I've been like building out product teams and like really understanding the culture of a company is like what is the role of product in any given company? And this, if you like talk to all these like different tech companies, they all take many different shapes. And the truth of the matter is it really depends on like how the product leader and the C-level wants to run the company, right? I've been lucky enough to work in companies in which product is at the heart of accountability and driving, by and large, the company forward. So as a result of that, my expectations on product managers are that they must own the P&L. And in order for them to own the P&L, they must understand all these input metrics, which include default rates and like profitability and so on and so forth. And perhaps this is unique to fintech product managers versus like, I don't know, like consumer or social or like health tech, like all those different industries probably have a much different cut of what is an effective product organization. But like my entire POV is I believe in building product organizations that are very lean, but these product managers are highly levered. And in order for them to be highly levered in the decision making, they must understand all the inputs of the P&L. And as a result of that, unless they're just not doing their jobs properly, they must understand all these input metrics, which requires them to work closely with not just risk teams, but like customer success, marketing, and so on and so forth, because that whole P&L shake is basically all these inputs of all these cross-functional teams. Um, yeah, that's the way I think about running product organizations and my expectations on the product managers within my teams.
That resonates a lot. I think a slightly related question is sometimes people talk about the risk teams more like the business prevention unit, the people that know and they don't let the customers in, etc. But of course, if you look at it from a business perspective, it's not really about risk. It's also about the reward you're getting for taking the risk. And in the end, risk is not bad. I mean, not all risk is bad risk. You just got to be intentional about which risk you want to take and make sure you also get compensated for it. So have you found any good strategies for focusing people more on the reward and balancing it versus just talk about the negatives here?
Yeah, that's actually super funny. Um, I'm a big believer actually in implicit incentives versus like explicit incentives. And I'll explain what that means in a second. So basically, like implicit incentives are like the soft things that is very hard to define, but I view them as like the competitive advantage. And these are things like culture and ownership. And and explicit things are like your metric goals or like how your team is organized and all these things. The reason why I say this is because these explicit, call it guardrails, are easily changeable and like everyone can change it any other day. It's messy, it's causing whiplash, but like these are like, it's not like rocket science. There's a few ways to organize the team and there's a few metrics that run an organization and so on and so forth. The thing that actually builds like successful companies is like implicitly within the people you hire. How do you reinforce the culture of like high ownership and thinking about the mission first, then the team, then yourself? So as a result of that, applying this to your question around like thinking of risk as as the no team, or like, for the lack of a better word, the defensive team is inherently against the culture that, you're trying to build. So as a result of that, you either push those people out or you redirect it. The way I think about it is risk is a part of the product and the product is a part of the risk. It's all intertwined and people must understand that. So that's number one. Number two is there are many ways to, like, the way I frame it is like, what is your right to win? And a lot of like, to be honest, a lot of Silicon Valley or Silicon Valley like tech companies, they like to believe that, oh, like our right to win is an amazing design. Our right to win is XYZ and like is in the product. But the fact of the matter is it doesn't actually have to be true, especially in financial services. And there's this and I'll get to the point in a sec. There was this like interesting example I heard from a podcast maybe like a month ago or something like that, where like the early head of product at Uber was basically talking about like what learnings he had when he was like scaling out Uber. And the thing that the main insight that really stuck to me is like he built all these like product teams that had like, I don't know, 10, 20 product managers that focused on these like little parts, bits and pieces of the experience. But when he took a step back, his main takeaway was none of that actually mattered because the only thing that like people cared about Uber is the price and how quickly the car got there in the early days. So like regardless of like what you do around the edges, it doesn't actually matter. So the point I'm trying to say is like in the early days of Uber, the right to win was price and speed, and like that's it. So when I think about like financial services, our right to win could be actually many different things. If you think you have a like, let's say you have like a beast of a head of risk or like a beast of an underwriting team or a unique insight on like these ICPs, your right to win could actually be risk. And then as a result of that, your product advantage is literally risk. Or, that's just like on the underwriting piece. And I'm sure a lot of the neobanks in these like developing countries, there's probably like a lot of the reasons on how they won, like Nubank as an example, about really good credit to, Brazil and so on and so forth. But the way I think about it is like, like risk can actually be your competitive advantage. So like the impetus on the product team is to find and like lean into all the best ways that you can win as a company, and risk could be at the very heart of it. It's what I believe in the US, where like a lot of like the PMs and designers are very much like user experience focused, which is like great. Like it's amazing thing to bring like provide good UX, but like we're in financial services, and the fact of the matter is that people care about money, people care about rewards, and that stack ranking of those things, risk is at the heart of being able to provide all those advantages.
Yeah, really interesting. There's a lot in there that I want to unpack,
Yeah.
and I would love to talk also about the right to win of fintech and also across geos, like you said in the US. So how does that compare across geos? But before we go there, maybe a concrete example. Do you have a concrete example for when you nudged or pushed the team to actually take more risk in a good way because there was risk that was rewarded in the market, and it was a good thing to go more aggressive?
Yeah, yeah. Here's an interesting one. One of the things that was missing is a pure play credit building feature that allowed people who are subprime or near prime to build up their credit in a safe way. Okay. You have the traditional secured credit cards in Canada, but not a feature like in the US, they have a kickoff and like self and a bunch of other these like credit building products. So like we were trying to stand up Canada's first credit building product. The thing is, the bureaus in Canada and the US treat credit building products differently. In the US, you can actually provide a fully securitized credit, like a line of credit, where you, as the underwriter, takes basically no risk because it's fully securitized against the customer deposit and help them build credit through that. In Canada, the bureaus did not allow a fully securitized product to actually build credit because their whole MO was like this wasn't representative of like their true credit health and so on and so forth, which completely makes sense. So we were like, okay, like how do we build a feature that helps people build credit in a reliable way, but also take on credit risk? And the risk that we took on was basically, and let me actually take a step back. And in order to help people build credit, we actually had to issue a line that was large enough. Like you can't give like $20. Like it's not gonna do anything to their credit score. We have to issue a line that was like $250, $300 or something like that, and like revolve it over time and like do the whole utilization thing. So how do we do that without like getting blown up in terms of our default rates and like our capital and so on and so forth, but also make the feature like applicable to the masses? And the risk that we took was a UX risk, which is if we position the product as a credit builder product rather than positioning it as a credit card or some sort of loan, and use our like back end ledger to like manage the money movement, we can actually help users protect themselves against using this money, because we realize that they don't want to actually use this money because they want to help build their own credit. So the risk we took is we basically underwrote whatever, like $250 on average of line of credit with basically no underwriting rules, and trusted the UX layer so that people don't actually draw on that line that often. And that was really scary because like, imagine you're the credit risk team and you're like, hey, we're not actually going to underwrite and we're just going to give this loan and trust the UX works, right? Which is like a crazy thing to think about. And it was really risky, especially for like, I don't know, at the time we were probably like Series B with like, and we were underwriting these loans off of our balance sheet, off of pure equity, which is also crazy. So like we set like right guardrails of like what an experiment looks like, how much money we're willing to lose, and just rolled it out. And the result of that was very, very low default rates. Like, I don't know. Yeah, sub 5%. I won't go into the exacts, but like really low default rates. And like basically, long story short, the margin that we were able to make on this product was quite positive, and like it was very value creative to both the users and of course our P&L. And yeah, that was like a big risk that we took. But in order to actually get there, we really needed to like work closely with the credit risk team to help them understand, like, we'll help the entire team understand like why it was important for us to do this, and so on and so forth.
I love this example, and also love how there's basically the risk, but then there's also the experimentation, A/B testing to actually then manage the risk down to something that's totally reasonable for a business. So
Mhm,
you have your canaries in your cohorts, etc. So
mhm.
you end up being pretty intentional about how much risk you take, how fast you learn, etc. I want to change gears a little bit and talk about the US as a market. You've also worked in other markets, so I think it's pretty nice because you have an outsider's perspective and an insider's perspective on the US market.
Yeah.
And then the first thing that stands out is data works differently across geos. And I think in particular, US data, I think you have a lot of experience. Would love to hear your thoughts on what's special about getting data about people for financial services in the US versus other countries you've worked in or.
My answer to this is a bit less formed, but here's like my broad strokes of it. My experience working in Canada, and even like in the early days of like UK versus the US, is that the amount of financial infrastructure around the US to support the multi products and multi fintech apps and all the use cases of the US is like far more than what Canada had at the time, like in the early days. As a result of that, you have these like all these different vendors who have like proprietary information on these users. And then you have layers on top of that, which is like, okay, then you have like these like SaaS tools that like aggregate all this information, like try to resell it to you or try to uh, add some sort of value or insights on top of it. And then like sell it to you so that you can do something else with for these users. My main answer to this question is the amount of infrastructure and information available for consumers in the US is so abundant that there's like, if there are things that unique things or unique insights and products you want to build for consumers, more than likely, there is a solution for you, you know? And in Canada, that's just not the case, which results in a lot of these like companies building bespoke things themselves. Like a good example I'll give is merchant categorization and enrichment. Like, imagine you're making a transaction and um, through your processor comes like your authorization stream, and you have like these parent-child relationships, and like you're trying to identify just like what this merchant is, where this transaction was made, should you give cash back, should you not, is it a fraudulent transaction or not, so on and so forth. And in Canada, in the early days, we built our own. Like, there was no other solution, right? And here in the US, like one of the things that we were like thinking on is like, okay, like maybe we can actually give like unique, uh, we can give cash back on specific merchants that consumers choose in their local town, and so on and so forth. But the infrastructure isn't there. Like, if we were to build it ourselves, it'd be crazy for us to like support or like basically like enrich the transactions of these like small town grocers. But we looked around and like, there's a company called Spade out in New York, and they took care of it, and they had all this like data that was available to help us enrich like our transactions so we can offer this product to our users. So this is a good example of like the time to market in the US is just much quicker because the availability of like data and infrastructure was very much there. Whereas like in my experience in Canada, a lot of it was you have to build it bespoke yourself, which is like capital intensive, or you just have to take on quite a lot of risk in like having crappy data, for the lack of a better word. Yeah, that's my experience there.
Cool. And I think the same domain, it is very remarkable that fintech in other countries, like UK, for example, is much more dominant than in the US. In the UK, I mean, Monzo and Revolut, I mean, they dominate basically everyone below 30 will work with that.
Yeah.
It's not true in the US that the vast majority of the population is with a fintech. I mean, the big banks still dominate the market. So why is that, in your opinion?
I think that's
Does it not change?
yeah. I think that's like it's probably like for most of the most people building in fintech's probably what the $500 billion question is like, why isn't the US like, like the hardest nut to crack? And like I have a couple of hypotheses that we'll see if it proves out. One of them is like, if you think about the macro markets, like competition, right? Like if you believe that competition makes certain products and services good, then then US has just far more banks than, I'll just talk about Canada. Like in Canada, I think that the top 5 or 6 banks have like 90+% of the deposits and user base and so on and so forth. So like the level of like experience that they offer and the type of products they offer is like X. In the US, like there's just so much competition, right? You have like thousands of these like multinational banks, you have community banks and so on and so forth. So like the experience for these consumers, although very poor, some of them is not that bad. Like when I first moved to the US 8 months ago and I had to like go get a bank account with that, and I didn't have like my social security number, so on and so forth. I walked into Bank of America. It was a pretty good experience. Even though I don't like to say it, I'm like, okay, like it's not that bad. Like you have this like free account. They'll give you this. They'll give you like a sign up bonus. Took 10 minutes. Didn't ask for that many documents. It was like a good experience. I'm like, okay, like the switching costs because of that is going to be massive, right? So that's number one. Number two is obviously I think finance. I relate like consumer fintech similar to like consumer healthcare, where like you see endless amounts of these like healthcare apps trying to like help you lose weight. Like everyone wants to lose weight. I think we can all agree on that. And you have different iterations of it, like Fitbit and so on and so forth. But why is it so hard for these like healthcare apps to actually help the consumer lose weight? Because everyone's like lazy, like it's hard to drag your ass to the gym and so on and so forth. And that's actually the case for consumer fintech. That's like my hypothesis is that consumer fintech, consumer healthcare, similar types of inertia to get consumers to actually change their behavior. So in order to do that, you have to have a super spike somewhere. Okay. Now going back to the third point, which I think is the most important point, is you need to think about the US and segment it as if it wasn't a country. Yes, it is a nation, but the fact of the matter is, imagine US and apply the lens of like, okay, instead of the US being like one nation, think of it as Europe. And like, I actually think that like the social, economical, the cultural divide, and like call it pieces within the US are so unique in itself. We've been lucky enough. Sorry, go ahead.
Yeah, and not even geographically, right? It's more about segmentation in other dimensions where US has everything. I mean, Facebook exists in the US.
100%, 100%. And like we've been lucky enough for where like, one of the insights that we had at Monzo was like, okay, like building out of Silicon Valley or building out of like New York, we have our own biases of like what people are and like the type of people. So in order to get rid of these biases, we literally have to go through a road trip in the US and go to different communities and like go talk to people and like understand how they bake and so on and so forth. So the point I'm trying to say is at the heart of how Monzo builds products and at the heart of how I think people should view the US is you need to not try to win the market of 100 million or 200 million people. You need to pick a very, very, very narrow ICP that's roughly big enough. But like in the US, most ICPs are big enough because the US is so big, and really get deep in terms of like how they are, what resonates with them, how you even advertise to them, because like these motions around like P2P or paid ads may not actually be true. Maybe they're community based and so on and so forth. So I think every company coming into the US should think of it in that lens and go very narrow and very deep in terms of the pain points, because that's how you can build a really successful product for these users, and use that as the the foundation to start building momentum in the US. Because it's a good, like, the way I think about it is like that is call it a pragmatic way to like think about capital deployment and all that. Because if you're trying to win the US, think of all the capital you actually need to like deploy to do that. And like, that's just like a crazy amount of money that is, unsustainable.
Yeah. Yeah, no, yeah, love it. And I think it echoes also the entrepreneurial journey of most people. They cast their net too wide in startups too, right? It's like VCs, you want you to have a massive TAM, but in the end, you got to nail a really small segment first. And you got to go to 1 million, go to 10 million, go to 100 million, but you know, you go step by step and sequential rather than going super wide.
Yeah.
Cool. I mean, this is the Risk and Robots podcast. So we cannot do a podcast without talking a little bit about AI. So final question here would be, what are you planning in your own products on the AI side? What are you excited about next? I would say horizon 12 months. So with the current technology, we're not thinking about another jump in
Yeah.
skill capabilities, but with what's possible today, what are you excited about building?
Yeah, yeah. It's a question that I've been thinking a lot about, and there's two lenses in which I'll answer this question. One is what Monzo's doing about it, and one is like what I am still forming in my head in terms of what I think, um, the direction of like just like here, like where like AI is going and how different companies can take advantage of this. So like for Monzo, again, like the core of what we are trying to do is serving our customers, and AI is a way for us to better serve our customer in whichever facet that we think makes sense. So, um, like there's like the unsurprising things, like most of these like consumer fintechs and most companies now are like trying out these like chatbots that are like help with like operational efficiency. But like a layer on top of that is like these type of products that we can build. But we're not going to build like AI products for the purpose of building AI products. We're going to build them to, if we believe it'll better serve our customer. The issue is, as I'm sure you're aware, there's just so much noise in the market right now, and there's like all these like vertical AI companies coming out and like consumer facing, business facing, and it's like hard to parse through the noise. And like I'll be the first one to tell you I am not smart enough to understand noise and signal and like all these things. I don't know which new AI startup and new AI product is going to win. That's just I just know I don't know that. So then the question I asked is like, given all this noise, what do I believe in with like more concreteness? And the two things are distribution will always have to be there. Like regardless of any product you build, how are you going to actually like distribute it? And I think that the game of distribution and go to market motions will change. And the reason why I believe in this, and this is the non-Monzo part, this is like the thing that I'm like really ruminating in my head, is consumer form. And I build for consumers, so like I'm just thinking about consumers for a second. It's like consumer form factors probably change in like once a 10 to 15 year generation. You have like desktop computers, mobiles, and now I believe that the form factors that Chat GPT really like set off over the past couple of years is changing how consumers consume information, digest information, and also like create things. So if you believe that in the next 12 months, the form factor that is like that is really like accelerated by all these like cheap GPT, Chat GPT tools, or chat by and large as the form factor, And I don't know if you just saw it, like OpenAI released the browser and so on and so forth. So like it continues to like
And the
reinforce.
shopping button too.
Exactly, right? It continues to reinforce like this hypothesis that like form factors will change, and the capability of like reading and writing into consumer apps will change as a result of that, because of these marketplace apps that are now integrating ChatGPT. So as a result of that, how do you distribute your product in this new world? And the way the through line here is, when you think about distribution and when you think about go-to-market motions, there's only a set amount of time in which you'll have a lot of alpha in this new form of distribution. Then it just goes into like competition, right? In the early days of like ad networks, the ad bidding was like much cheaper, and like all these companies had huge amounts of alpha because it was cheap. But now it's like super expensive, and like performance marketing is just highly competitive because everyone's doing it. So, going back to this, it's like, if this new form factor is changing and it's changing rapidly, where can any consumer app, Monzo, Coho, or any company that is like really like building for the consumer, find the alpha in how they think about distribution and go to market motion? So that is the thing that is I'm trying to like really wrap my head around right now. I would say that's 30% formed, but yeah, that's how I think about it.
Yeah, you can totally imagine somebody asking ChatGPT for financial advice. Say, hey, look, this is my situation. And then you could imagine ChatGPT goes off to some aggregator and says, hey, look, you can get this and that product. You want to do that? And also move your money, by the way. So this will change the game in terms of access and discovery, etc. I mean, very
Totally.
from what we have today.
Totally. I think like on that point, the lens that we also have to apply to it is somewhat around like the regulatory like framework around it. Like there's highly regulated industries and there's like less regulated industries. Like banking obviously is like a lot more regulated, whereas
Financial advice as well. I mean, somebody stops you from asking ChatGPT for financial advice.
that's true. That's true. And like the thing that I think about is like, Monzo aside, there's a bunch of like, my point earlier, there's a bunch of these like infrastructure players and like data players in the financial services industries, especially in New York, in America. They're probably thinking to themselves like, okay, like if we believe these changes in form factors and like, like proprietary data and so on and so forth, how do we avoid being disintermediated by ChatGPT or all these things? And that's probably like far more like of an interesting like thought exercise than like, um, what AI products should we build now? Because like, again, like there's a lot of noise. All these things around form factor distribution, I believe in far more um, than being able to predict which kind of AI products will win.
Yeah. And I think there's the next layer of the question, which is that I think chat is an interim form factor. I am very sure that in 3 years' time, it'll not be this, type your question answering. I mean, that is just turned out LLMs are good at this, and it was the first thing we figured out to do. But there's obviously way better ways of interacting with an intelligent system and presenting information, etc. And obviously, OpenAI is working on hardware and potentially be voice, potentially, you know, a vision set. Maybe it's a brain implant, but I think the whole chat thing will also go away relatively quickly. But it's so hard to prepare for something that we don't even know what it'll look like.
Exactly.
And it should be weird in the next 5 years.
I agree. And I think that's like, for me at least, that's why I choose, like, I'm more hesitant to like form a strong opinion on like the shape of AI products, because the shape of these products is beholden to the form factor of the consumer. Do you know what I mean? Like the people like us can't decide, or aren't probably in the best positions to decide how do consumers consume information. Like that is not like, yes, we can go work for these kind of companies that probably shift these trends, but like there's less power, like we have a bit less influence in that. So as a result of that, if you make a bet on form factor, you'll probably make the right bet on the kind of product you build.
Love it. Cool. Peter, thanks so much. That was terrific.
Awesome. Thanks, man.
Thanks for joining us on Risk and Robots. To find out more about the future of risk, follow me on LinkedIn under Maximilian Eber. And to learn about how Taktile is powering next generation risk decisions, go to taktile.com, taktile.com.